So, the buzz is back. We're hearing more and more talk about a new $2,000 stimulus payment. For many, that's a lifeline. But for Bitcoin investors, it sparks a much bigger question. Could this be the event that finally sends Bitcoin to an incredible $200,000 this year? Now, let's be clear. As of early November 2025, no new stimulus payment has been approved by Congress. What we are seeing are proposals and rumors, like the idea of a tariff dividend floated by Donald Trump that would put around $2,000 into the pockets of most Americans. For a market that feels like it's constantly on the verge of a major move, the thought of millions of people getting an extra $2,000 is electrifying. Everyone is asking if this is the catalyst we've all been waiting for. In this video, we're going to break down the real impact of retail stimulus on Bitcoin. We'll look at what happened in the past, do the math on what a new round of checks could mean for the market, and most importantly, we're going to separate the hype from the reality. We have the answer, but it's more complicated than a simple yes or no. We'll dig into the massive influence of institutional money, Federal Reserve policy, and Bitcoin's own built in code to give you a realistic outlook. By the end, you'll understand the whole picture, not just one small piece of it. Just picture it. A sudden, unexpected $2,000 deposit hits millions of bank accounts. What happens next? For some, it's about paying bills, catching up on rent, or finally getting the car fixed. But for a growing number of people, that money is an opportunity, a shot to invest, a chance to take a risk on an asset they believe could change their financial future. The last time this happened, we saw an explosion in retail investing that shook Wall Street to its core. But the question today, in late 2025, with Bitcoin recently trading in the $102,000 to $107,000 range, is different. Is a wave of retail money still powerful enough to double the price of an asset with a multi-trillion-dollar market cap? Or is it just a drop in an ocean now dominated by giant institutional whales? That's the tension we're going to explore. To really get why a potential $2,000 stimulus is such a big deal, we need to look at where the market is right now. It's late 2025, and the air is thick with anticipation and a bit of anxiety. Bitcoin has had a strong year, but has been moving sideways, hovering around the $102,000 to $107,000 mark, after a big liquidation event in October shook a lot of leverage out of the system. This kind of tight price range creates a pressure cooker. It's the quiet before a possible storm, and every trader is looking for the one sign that will trigger the next big move. This is exactly where the stimulus idea comes in. A proposal like the tariff dividend associated with Donald Trump isn't just a news headline. It's a huge psychological event for the market. It represents a sudden injection of billions in disposable income. And these days, disposable income for many younger, digitally native people might as well be called investment capital. Let's look at the economic climate that makes this kind of policy even plausible. Governments are still dealing with the economic echoes of the past few years. And while inflation has been a worry, concerns are now shifting toward a cooling labor market and a potential slowdown. In response, central banks are starting to pivot. The Federal Reserve, for instance, has already made a couple of interest rate cuts in 2025, and forecasts from institutions like JP Morgan Research and Morningstar Project, this easing cycle will continue into 2026. This environment, where it gets cheaper to borrow and less attractive to hold cash, is historically a massive tailwind for risk assets, and Bitcoin is at the top of that list. A stimulus check in this context is like a direct to consumer version of economic easing. Instead of just lowering rates for banks, it puts money right in people's hands. From the government's view, the logic is to spark spending and boost the economy. But the modern investor, scarred by inflation and armed with commission-free trading apps, doesn't just spend, they speculate. They invest. They look for ways to make that money grow faster than inflation can eat it. This sets up a fascinating dynamic. You have a market technically coiled for a big move. You have a macro backdrop of falling interest rates that favors rising asset prices. And then you have the potential for a sudden cash injection that could flow right into the most exciting investment of our era, Bitcoin. The stimulus isn't just money, it's potential energy. The question is, how big would the explosion actually be? Is it enough to create that God candle to $200,000? Or are bigger forces at play? So, what's the bull case? How could a $2,000 check send Bitcoin into the stratosphere? Honestly, we just have to rewind a few years. The stimulus rounds of 2020 and 2021 were a grand experiment in what happens when you mix free money with friction free market access. The results were explosive. Study after study at the time showed a clear link between stimulus checks hitting bank accounts and a surge in retail trading, with a big chunk of that money flowing right into crypto. Think back to that time. The narrative was simple and incredibly powerful. The government is printing trillions, so put your money in a provably scarce asset they can't make more of. Bitcoin wasn't just an investment, it was a lifeboat. This resonated deeply, especially with a younger generation feeling locked out of traditional wealth. The stimulus checks were their ticket in. This wasn't some niche trend. This was the same energy that fueled the meme stock mania with GameStop and AMC. It proved that when millions of small investors act together, they can generate buying pressure that rivals huge hedge funds. The retail investor, once called dumb money, showed they could move markets. A new stimulus round could be an attempt to light that same fire. Now let's do some hypothetical back of the napkin math. The US has around 330 million people. Let's be conservative and assume, due to income caps, maybe 150 million adults would get a $2,000 check. That's a $300 billion injection into the economy. How much goes into Bitcoin? This is speculative, but we can use the past as a guide. Previous surveys suggested anywhere from 10% to 50% of stimulus for younger investors went to stocks and crypto. Let's take a bullish but not crazy figure, 10%. If 10% of that $300 billion hits Bitcoin, that's a $30 billion buy order. $30 billion. For context, Bitcoin's daily trading volume can be anywhere from $30 to $70 billion. An extra $30 billion in pure buying pressure, all hitting over a few weeks, would be a massive shock to the system. And here's where it gets crazier. That $30 billion is the direct impact. The indirect impact could be way bigger. A fast price spike from retail buying would trigger a cascade. It would ignite FOMO, the fear of missing out, in everyone on the sidelines. It would force short sellers to buy back their positions, adding fuel to the fire. It would trigger trading algorithms programmed to buy on momentum. Most importantly, it would dominate the news. Bitcoin surges as stimulus checks hit bank accounts. The narrative would be irresistible, acting as a massive free marketing campaign, pulling in even more retail investors. This is how parabolic moves are born. It starts with a catalyst, the stimulus, which creates a price shock, which creates a media feedback loop that sends the price vertical. In this bull case, that $2,000 stimulus isn't just a $30 billion buy order, it's the match that lights the rocket. Okay, before we all start drawing rocket emojis on the charts, let's inject a serious dose of reality. Powerful forces are at play that could make a retail stimulus check almost irrelevant. First, let's challenge our own math that $2,000 isn't play money for most people. We're talking rent, groceries, gas, and paying down credit card debt. The economy today isn't the lockdown economy of 2020. People are out spending and financial pressures are different. It's very likely a much smaller fraction of this stimulus would hit speculative assets this time around. But even if we take our optimistic $30 billion inflow, is that even a lot for Bitcoin anymore? In 2020, when Bitcoin's market cap was a few hundred billion, a $30 billion injection was seismic. Today, with Bitcoin's market cap in the trillions, it's a different story. A $30 billion inflow into a $2 trillion asset is a 1.5% bump. It's not nothing, but it's hardly rocket fuel. This brings us to the biggest part of the bear case. Retail stimulus is a tiny drop in an ocean now dominated by institutional giants. The real story of this Bitcoin cycle isn't retail. It's the relentless, systematic buying by the world's biggest financial players. Let's talk about the Bitcoin ETFs. The launch of spot Bitcoin ETFs from titans like BlackRock and Fidelity has fundamentally changed this market. This isn't people buying a few $100 on their phone. This is pension funds, endowments, and corporations allocating billions. Since their launch, US Bitcoin ETFs have seen cumulative net inflows of around $60 billion. On some days, a single ETF like BlackRock's can see hundreds of millions in flows, a huge chunk of what we'd hope for from an entire stimulus event. Institutional capital is the whale. Retail stimulus is the plankton. The whale decides which way the current flows. Beyond ETFs, we have macro forces that dwarf a one-time check. The single most important factor for Bitcoin's price is arguably Fed policy. When the Fed cuts interest rates, as it has started doing in 2025, it pushes trillions of dollars across the global financial system to look for better returns. A tiny fraction of that global capital moving into Bitcoin has a far more profound impact than a temporary influx of retail cash. Analysts like Tom Lee cite Fed rate cuts as a key reason for their bullish targets, not stimulus checks. Finally, let's not forget Bitcoin's killer feature, the halving. The April 2024 halving cut the issuance of new Bitcoin in half forever. This is a programmed supply shock. Every day, far fewer new coins are available for purchase while institutional demand from ETFs remains high. It's basic economics. When demand outpaces a shrinking supply, the price has to go up over time. This is the real engine of the bull market, operating 24/7, independent of any stimulus plan. So the bear case isn't that stimulus would be bad for Bitcoin. It would almost certainly help. The argument is that its effect would be marginal, temporary, and utterly dwarfed by the colossal forces of institutional adoption, Fed policy, and Bitcoin's own code. So, we have the bull case, retail rocket fuel, and the bear case, a drop in the ocean. Where's the truth? As usual, it's in the middle. To get a real picture of Bitcoin's path, we need to stop looking for a single catalyst and start thinking in terms of a catalyst stack. Imagine a multi stage rocket heading to the moon. Each stage fires in sequence, building on the momentum of the last. This is the perfect analogy for Bitcoin's journey to $200,000. Stage 1, the foundation, the halving supply shock. The base of our rocket, the part that got everything off the ground, is the 2024 Bitcoin halving. It permanently slashed the new supply of BTC. This is a mathematical certainty coded into the network. This supply shock is the foundation, ensuring that any new demand has an outsized impact on price. This stage has already fired. Stage 2, the main engine, institutional adoption and ETFs. The second stage, the massive engine providing the primary thrust, is institutional adoption through spot Bitcoin ETFs. This is the game changer. Trillions of dollars managed by the world's biggest asset managers now have an easy, regulated on ramp to Bitcoin. The daily flow data for these ETFs is the most important metric to watch. This is why you see big banks like JP Morgan and Standard Chartered floating targets from $170,000 to $200,000. Their math is based on ETF flows and Bitcoin's potential to rival gold, not on retail hype. Stage 3, the guidance system, favorable macro policy. The third stage is the guidance system, setting the rocket on a perfect path. This is the macroeconomic environment, specifically the Fed's actions. An environment of falling interest rates is like a massive tailwind. When money gets cheaper, it pushes investors away from boring bonds and into assets with higher growth potential. The current expectation of more rate cuts creates the ideal flight path for our rocket. The booster, retail stimulus. So where does our $2,000 stimulus check fit in? It's the final piece, the booster rocket. It's not the foundation or the main engine. It's a powerful, short burst thruster strapped to the side to provide a jolt of acceleration. It can help the rocket smash through resistance levels and generate a burst of speed that gets everyone excited. A sudden retail influx could absolutely be the event that starts the next leg up. This shows us the bull and bear cases are both right, just incomplete. The bears are right that stimulus isn't the main driver, but the bulls are right that it could be a critical trigger. The rocket is built, halving, it's fueled, ETFs, and its flight path is clear, Fed policy. The stimulus could be the ignition sequence that sets it all off. So, what's the final verdict? Will a $2,000 stimulus check take Bitcoin to $200,000 this year? No, not by itself. The idea that one round of checks can single-handedly double the price of a multi-trillion-dollar asset is a fantasy. The forces that can truly drive Bitcoin to those heights are far larger and already in motion. The key takeaway is the catalyst stack model. The foundation is the Bitcoin halving. The main engine is the colossal wave of institutional money from ETFs. And the journey is guided by the tailwind of falling interest rates. These are the three pillars that can support a price of $200,000. And they're why analysts at major banks like Standard Chartered and JP Morgan are setting such ambitious targets. The $2,000 stimulus check is the wild card, the booster. It's not the rocket, but it could be the spark that ignites the main engine. It could provide a powerful burst of demand that shatters complacency, triggers a wave of FOMO, and accelerates the timeline. It could turn a slow climb into a spectacular vertical launch. The groundwork is laid. The institutional money is here. The macro environment is supportive. Whether we hit $200,000 this year depends on the strength of these core pillars. A stimulus would just make the journey faster, more explosive, and a lot more exciting. But now I want to turn this over to you. Let's make it personal and run our own experiment. If that hypothetical $2,000 landed in your bank account tomorrow, what would you do? Bills, invest somewhere else, or would you put it into Bitcoin? Let me know in the comments below. Be honest. What percentage would you allocate to Bitcoin? Your answers will give us a real time snapshot of how powerful this retail booster might actually be. And if you got value from this deep dive, no hype breakdown, make sure you hit that subscribe button and turn on notifications. This market is moving fast and you don't want to miss what's coming next. Thanks for watching, and I'll see you in the next one.